Good evening, friends. Warm welcome to one and all for the 13th session of the Super 25 program, India's largest online stock traders conference. And I'm sorry I didn't find time to inform Kiruba that his session number is wrong because of the problem that we faced. Anyhow, uh, on behalf of all the people here, I would like to welcome Kirubakaran Rajendran for this session. He is the founder of SquareOff.in. I know Kiruba personally from the past 3 years. I still remember that meeting which happened in Chinnaswamy Stadium at Bangalore, that Kiruba had a vision of creating this company called SquareOff. We had a over the dinner conversation. So he was putting over his thoughts about starting the firm. I guess you were still working then, right, Kiruba?
Yes, yes, yes. I was working that time and just came to came for this algo conference from Chennai to
Yeah.
Bangalore to meet the algo traders.
So, and I was so excited to meet him because I was an algo trader then. I had a very limited algo trading community. There were hardly two guys in Bangalore whom I knew algo, who, whom I knew and who were doing algo trading. So, so it was really great to be introduced to him, and he has traveled a long journey in the trading world, and he has contributed a lot to the community. That is really outstanding, and I'm so happy to be associated with him in this program. Kiruba, on behalf of the entire Super 25 audience and the extended Traders Gurukul community, I welcome you to the program as a speaker, and thanks so much for accepting our invitation and being with us today to share your knowledge in the next 2 hours with our audience.
Cool. Thank you so much, Ashok. Thanks for the invite. Now it's even really pleasure sharing all this informations and all these trading strategies with the community and whatever the things that you guys did. 25 different traders and 25 different strategies. It's really whatever things that you've did is really good. And that too after market hours, so we have enough time. And also we are giving a recorded session. People who are not able to attend. So you are doing a really good job, and I'm really excited to be part of it. So thanks, guys. So sorry to keep you wait. So we'll start the session. So as Ashok said, my name is Kirubakaran Rajendran. I'm the founder of the firm SquareOff.in. It's an algo trading firm where we specifically develop algo trading strategies and provide a fully automated platform to retail clients. So in today's session, so we'll be specifically talking about a rule-based trading strategy. So many people are familiar with weekly options expiry. So since the time Bank Nifty weekly option is introduced, it has got a huge traction. There are so many people who are into weekly options. Some people buy weekly options at the time of expiry, expecting it to make 10x, 20x returns. And there are people who are consistently making money using no option sellings, and no, there will always be an issue with respect to option selling strategies. Like no, as long as the market is calm and steady, everybody makes money with respect to option selling. And only issues comes when the market turns into a volatile phase. People face issues, they firefight, they keep adding positions. So there will always be a certain issues with respect to no option selling strategy. So what we are going to cover in this session will be a complete rule-based mechanism where I'll be explaining 5 steps using which anybody could get into an option selling strategy. They don't need to know about gamma, theta, delta, all these technical terms. Any beginner could do this, and you don't need lakhs of capital. With a minimal capital, you can do this strategy. And second most important part is any working professionals can do this strategy. They need to do is just spend 5 to 10 minutes of the day, using which you would know which strike to short, and you can just place order. You can continue with the work. So that is how this particular system is designed. So I'll go ahead and explain it. So before I go ahead and start explaining, the strategies, and instead of having just plain one-side conversation, I'll keep asking a couple of questions in between during the session. You can just respond to it, and accordingly we could pick it up and we'll address it. So we'll start the session and go to webinar with our sponsor. So even though they messed up today, still it helps to connect a lot of users, thanks to GoToMeeting. And second, so why option selling? So we have multiple strategies. Like we have intraday strategies with stocks, we have trend following strategies with futures. Of all this, why specifically option selling? And people who are into option selling, like if you already tried option selling strategy, what is the most one important issue that you usually face? Like you could just respond it in the as a message in the chat window or in the questions window. What is one important issue that you guys face with respect to option selling? Be it finding a stop loss, or be it not knowing when to enter, or handling the volatility. So what is the most important issue that you guys face? Ashok, you could check the chat and you can just let me know.
Sure, sounds good.
So you can just
Gaps and
check. No,
volatility, stop loss, stock strike price selection, unlimited risk
okay,
profile,
okay, okay, okay.
VIX,
So
India
yes,
VIX.
got it. So most of the main issue is gaps. Like people tend to afraid of gaps. Like what if in case the position goes against me? And second thing, what if in case there is a high volatility that occurs? So first thing is with respect to gaps, you don't need to worry about the overnight gaps because this is specifically focused on intraday strategy. It is not holding any overnight positions. So the overnight positions is not going to affect us. And second, even if there is a high volatility, we have a certain on off parameters. Like just like how it is really important to know when to trade, it is equally important when not to trade. So we have a switch on switch off parameter that I'll explain in the coming session, when not to use this strategies, that is also there. And handling this wicks, so even if the wicks is high, wicks is low, this strategy has been tested since the day bank nifty option is introduced. So from that day to till date it is tested, which has covered all the scenarios: the low volatility, high volatility, surgical strike, demonetization, everything is covered in this during the complete backtesting period. So you don't need to worry whether it works in low volatile or high volatile. Irrespective of the volatility, the strategy would work since it is a directional strategy. So coming to the point, so why option selling? So the main thing is with respect to option selling. So there are three scenarios usually every trader would face with respect to making a trade. Let's see, you have a bearish view with respect to market. So you see, okay, market is going to go down in the next couple of weeks. So you have two options. So as an option buyer, you just buy a put option. So that is what an option buyer can do. So you have a bearish view, you expect the market to go down. So as an option buyer, what he can do is he just go and buy the put option. So once he buys a put option, only there are three scenarios that can occur in the markets. Either the market can go up, or it can go down, or it can stay flat. It can stay and no trade in the sideways trend. So a guy who is buying a put option during the first scenario, if the market is going up, his view is wrong, so he's not going to make any money. So whatever the money that he has bought the put option, it is going to expire worthless. So he loses the money. Second, he bought the put option and the market is going down. So his view is right. So when the view is right, he makes money because once the market moves down, the put options that he bought, the premium will keep increasing. So obviously he'll make returns. In the third scenario, when the market stays sideways, neither it moves up nor goes down, it stays flat. In this scenario, the guy who bought the put options, he'll not make money because the premium will decay. So the buyer of the option can make money only if this view is right, and also the view needs to be right and the market movement needs to be swift. If it stays flat, obviously the premium will decay and he'll not make any money. Whereas with respect to option seller, we'll consider the same three scenarios. So he has the same bearish view. So instead of buying the put option, he is going to buy, short the call option. So he shorted the call option. In the first scenario, the option seller loses money because his view is wrong. So the market is going up, whereas his view was market is bearish. So obviously the call option that he shorted is going to keep increasing, though, so he is going to lose money. So both the buyer and the seller loses money when their view is wrong. Second, the option seller makes money when the view is right. Obviously, the market goes down, so his call option would tend to decrease, the premium would tend to decrease, so he loses money. I mean, he loses premium, so he makes money. And third scenario, where his view is not right. So the market neither moved down nor moved up, but still the option seller makes money because he shorted the call option where the premium decay happens, and no, three out of two, no, out of totally three scenarios, in both the scenarios, two scenarios, the seller made money. Whereas the buyer, only when the view is right and only when the no direction and the movement is swift, the option buyer can make money. Whereas the seller, two out of three scenarios, he makes money. When the view is right, he makes money. Even if the market stays flat, he makes money. Only when the view is wrong, he loses money. So what happens is with respect to option selling, even though they say it is having an unlimited risk, nobody is going to trade a naked option. You're not just going to short the call option and keep hoping the market should go down. There should be a certain risk management parameters one should follow. Only then, no, you could make money with respect to option selling. So once you control that unlimited risk factor, there is always no enough money that you can make. So the slide that you are currently seeing is the total normal distribution chart of how the Bank Nifty moved on the expiry days. So this is, as you could see, 70% of the time market stays in range bound. Only 30% of the time it trends. So there is a statistical data. So even if you take the Nifty or Bank Nifty or whatever the instrument that you trade, if you take it and plot a normal distribution, you could see the market trends only 30% of the time. Remaining 70% of the time it stays range bound. So we took and we found out how the Bank Nifty usually moves on the expiry day. And as you could see, the maximum number of days it has moved now beyond between 0.3% to minus 0.3% to plus 0.4%. That is a maximum movement, maximum number of times Bank Nifty stayed in this range on every expiry day. So even though there are days where the Bank Nifty moves volatile or when it is highly volatile during the expiry day, 70% of the time definitely it's going to stay in range. So all we have to do is create a strategy and create a risk management system where you make money during the 70% of the time, and remaining 30% of the time all we have to do is control the risk, minimize the loss. So you should have a specific rule based mechanism to minimize the loss on the remaining 30% of the time when the Bank Nifty is highly volatile, that you are making money with respect to option selling. So that is how this specific strategy is designed. So with respect to option selling, by default, the option selling itself is having an edge because of time decay. And second thing, when the market turns highly volatile, we bring in a specific risk management rules to control the risk and limit the losses so that overall we make higher returns. I'll explain those risk management part in the coming slide. So is it clear so far so that I could go ahead and get into the explanation about this option selling part?
Yes, please go ahead, sir.
Cool. Okay. So I'll take a real case study which happened in real time in 2018, 2018 between February to March. Yes. So they call it as Walmageddon. So what happened is if you have traded during the period of 2017, so that is the period where market completely stayed flat. It neither moved up nor moved down, or it was continuously trending up, and there was no bigger down moment at all. Market was completely calm and steadily moving up every day, and most of the small caps, mid cap stocks, every stocks were making no all time high, and it was the best year after many years because all the stocks were moving up, and it was the great year for option sellers because there was not even a single corrections or big correction that has happened throughout 2017. So what happened, and it is not only specific to India, it is across all markets. 2017 has seen the lowest volatility ever, and the market was completely stable. Because of this, many hedge funds in the US markets who were trading in the US markets, they started specifically trading based on this derivative segments, which is specifically based on option selling part. So there is one, Chicago-based hedge fund called LJM Partners. So these guys, what they do is they, specifically concentrate on derivatives trading, where they make money if the market is flat. They just, keep selling the options, and they make consistent returns. They have made huge returns where their asset under management has grown from couple of millions to almost $800 million in 2017 alone.